Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. There's just an hour to go now until the closing bell, and stocks, they are extending gains from Wednesday's rally. Our very own Jared Blickery standing by with all the headlines. Jared.
Yes, Josh, we have now recovered most of those losses from earlier in the week. And let's check out what the Dow is doing here. We can see it's been in the green the entire day. Here is the entire week. So we are now 4 days in. It is still a little bit negative, but some nice comeback there. You can see a very similar situation. The NASDAQ still down about 0.5%, but it is up about 86 basis points today. And the S&P 500, very similar to the NASDAQ there. But the Russell 2000, again, the small caps is where the action has been. Very much positive, up 1.84% this week, up another 1% today. So that's where we're seeing some of the strength. And the mid caps, which notched a record high yesterday, well, they're down just a little bit today. So not everything is green, but I do want to check in on the bond market as we see volatility in stocks and bonds coming down. Let's check out today's price action. You can see down just a fraction of 1 basis point, so that we're going to call that break even. Here's the 30-year, 4.85%, down 2 basis points, down as the right direction off of that high of 4.95% that we saw earlier in the week. And the dollar also down about 0.4% there. And let's check out the price action in the sectors. And we can see the 3 mega cap sectors, those are leading. Communication services up 1.26%, followed by consumer discretionary and then tech. Financials also outperforming the S&P 500 here. And to the downside, real estate, industrial, staples, and utilities, those are your underperformers. 3 of those, not industrials, but these 3 here are defensive sectors. So this just kind of adds to the bullish flavor that we're looking at today. And then looking at the mega caps, we see Tesla up 3%, Microsoft, Amazon each up 1%, and Meta, check out Meta, up over 5%. And let's track what the semiconductors versus software is doing. We see a bit of green, a bit of red here, kind of an even split. And let's check out the software as well. So this is a software day, not a chips day. And we can see Oracle there in the news. That is up 2.5%. Back to you, Josh.
All right. Thank you, Jared. Well, a bright spotlight is on the AI trade as big tech earnings now come into focus. Investors remain concerned that there is an AI bubble at play, but our next guest says AI worries are overblown. David Wagner, Aptus Capital Advisors, head of equity and portfolio manager, joining us now. David, always great to see you. Let's start there on AI, David. You say here the worries of AI, they're overblown. You said there are good bubbles and bad bubbles. Walk me through that, David.
Yeah, Josh, always great seeing you. If we go back in time to back when we were in school, we're taught that all booms lead to busts. I mean, we legitimately have to learn about the tulip mania, the tulip bulb crisis of the 1630s, and we try to relate it to today. Well, I think we need to be more pragmatic and see the forest through the trees on how there's different types of bubbles out there. As you pointed out, Josh, there's good bubbles and there are bad bubbles. Everyone thinks every single bubble is bad. The bad bubbles are ones centered around commodities, around gold, housing, things that are very much financed by banks. But there's good bubbles out there too. And I know that a lot of money was lost during the 1999 dot-com bubble, but in my opinion, that was a good bubble. And I think the main characteristic that drives a good bubble versus a bad bubble, it all comes down to productivity. I mean, the internet was one of the most revolutionary technologies we've seen today that led to so much productivity. It might not all have been seen and witnessed back in 98, 99, and 2000. I mean, it wasn't until like 2004 that Facebook was created. Uber wasn't created until 2012. All of those are born from the internet itself. And it's obviously changed the economy much for the better and for the good. And I think that if there is some type of AI bubble, which I don't think that's the case by any means, I think there's an opportunity for an air pocket of some sort in earnings this year and or next. I don't think it's in bubble territory right now. But at the end of the day, we know this revolutionary technology of advanced computing, it's going to advance the productivity of the market here in the U.S. and across the entire world.
Some also, I think, David, they looked at what Taiwan Semi recently told us, how they're going to earmark as much as $56 billion in capital spending for 2026. That was stronger than expected. They expect revenue growth of about 30% in 2026. That was faster than expected. I know some looked at that report, David, and they concluded, hey, I think this AI boom is sustainable, is durable. Is that what you took away from that report?
Yeah, if you look underneath the hood of the market, The AI trade has definitely advanced to kind of the smaller cohorts. Just look at the semiconductor ETF, pardon me, SMH. Like 30% of that ETF is going to be in Broadcom and Avgo. And those names are basically flat on the year. Yet the ETF's outperforming the software ETF year to date by about 22%. So you've seen this broadening out with like Micron, Intel, SWKX, WDC that have definitely been beneficiaries of a lot of that information that's come off of Taiwan Semiconductor. But I'd take that a step forward there too, Josh. I think that's a pretty big optimistic sign for emerging markets. Taiwan Semi is about 12.5% of the emerging market indices. And to your point, it's growing earnings at 31%. That contributes to about 4% of the overall index itself. So given where valuations are there, I think the EM space is a great spot to also look out for the market to continue to broaden out, pardon me.
More broadly, David, you indicate here the bull market younger than many would think. What do you mean by that, David? And what are you suggesting about how much further this market could run?
Yeah, Josh, I was saying here that, bears sound smart, but bulls make money. Everyone wants to equate, bull markets to a baseball game. Say, hey, we're in the 7th, 8th, 9th inning of the baseball game in this bull market rally. And obviously we've had, great high velocity returns since the tariff bottom back in April, or even back to October 27th of 23 or October 12th of 2012. Like, we had great returns. We had a lot of right tail environments, which I love. I embrace it, and I want more of them. But that just makes a lot of people believe that we're close to the end of this business cycle, which I think is firmly incorrect. The average bull market tends to last about 65 or 66 months. Really, since the October 2022 bottom, we're only 39 months into this bull market. But not only from a duration standpoint, you could also look to a performance standpoint. The market is up 91% during that time frame. The average bull market tends to last, up 190%. And one cool statistic or superlative is that whenever the market has hit its third birthday from a bull market standpoint, it's always lasted at about 5 years. So again, bears sound smart, bulls make money. I think it's really imperative that investors continue to invest in risk assets, i.e. stocks.
And so when you say invest in stocks, David, where are the opportunities? What are you screening for?
Yeah, I think the two biggest opportunities I would go. The first one is I continue to love the barbell trade that I've spoken with you multiple times, Josh, on owning the mega caps and also own the small caps. I think one of the craziest stats I've seen on that is so far year to date, small caps have beaten large caps every single day so far in 2026. That's 14 straight days. That's the longest on record since 1996. So I continue to like that barbell trade. But I think where I see the most amount of value is owning high quality stocks. Last year, the market witnessed one of the largest from a size perspective and a duration perspective of low quality stocks outperforming high quality stocks. So I think as the market becomes a little bit more rational, you're going to see that baton get passed off from low quality to high quality. So invest in stocks that, one, have positive earnings, short interest, lower than average debt on their balance sheets, and have actual growth and great profitability metrics, to be honest. So I think between those two things, I think that's where I'm seeing the most amount of value in this market.
Yeah, your point about small caps there, David. I mean, I'm just looking at the IWM, already up about 10% year to date. What a run. Finally, David, just quickly, I want to get your thoughts about the Fed, how the Fed plays into your forecast for 2026. If you have a preference there, David, on the next Fed chief, that race continues. I'm just looking at Polymarket as well here. It looks like Warsh is in the lead. Give me your thoughts there.
Yeah, I think, we're accounting for 2 rate cuts this year. That's no different than what the market's pricing into. I think just mentally we have to adjust that. We may no longer be in a rate cutting cycle. I think we might be more in an environment where it's a rate adjustment cycle. A lot of the moves that the Fed makes this year could definitely get, reversed in 2027 if we continue to see the amount of growth that I'm expecting to see in 2026. But when it comes to Fed chair, all I know out of that situation is probably 2 things. One, come July 2026, whoever's going to be Fed chair, they're going to have the most difficult, hardest job in the world. I don't want it. I don't want to be anywhere close to that position. I think that, obviously you have the 3 Kevins and then you have, BlackRock's blanking on his name right now, Josh, I apologize, but there could be a 5th person that he throws.
Rick Rieder.
Rick Rieder. Thank you.
Sir.
God bless you. You're so smart. I think Donald Trump could kind of throw a fifth name into the hat there, and that would be himself. Obviously, that's outlandish, that's crazy. But what he learned from 2018 with Jerome Powell was like, hey, I think I can put the right person in that seat. But they're going to be pragmatic in their expectation for what the Fed should do. It's going to evolve over time, and I think right now why it's taking President Donald Trump so long to pick a new Fed chair is that he just doesn't trust that they're going to follow through with what they're telling him. And him and Scott Bessent during the interview process, that they're going to try to cut rates down to 1%. So I know it's kind of outlandish to throw, Donald Trump into that picture, but I wouldn't put anything past that man right now.
David, always great to see you and to have you on the show. Thank you.
Cheers.
Well, Intel's earnings report after the market close is set to test the rally in chip stocks. Investors looking to see if the company is able to live up to the growing optimism on Wall Street. Yahoo Finance's Laura Bratton joins now with what analysts are watching for. Laura, break it down.
Yeah, so even though there's been a lot of optimism on Intel shares recently, the stock's up about 46%.
It's a rocket ship.
Yeah. Right, over the last month, and it's gotten a number of upgrades from different investing firms, whether it's HSBC or KeyBank Capital Markets, because I think there's a lot of longer-term optimism over a turnaround and the foundry getting some momentum. But there's a little bit of a disconnect with expectations for the fourth quarter. So analysts actually expect earnings per share to decline about 33%, to just 9 cents. And then revenue to fall about 6% to $13.4 billion.
Foundry you mentioned there. What are expectations there? What are you listing for there?
Yeah, so really, I think analysts want to see and investors want to see that there's still progress with its 18A manufacturing process, which was used to make its Panther Lake chips for AI PCs. And that's also the process that's going to be used to make its data center server chips, Clearwater Forest. So really just wanting to see that 18A is on track and that, its upcoming manufacturing process nodes 18AP and 14A are also on track. I don't think that we're going to see any big deals announced, but some of the reasoning behind the upgrades. One analyst, John Vin at KeyBank Capital Markets, thinks that he sort of added to rumors that there could be a deal with Apple coming up, to use 18AP for low-end Mac processors and then potentially to use 14A for low-end processors for iPhones in 2029.
What about AI? How is that sort of impacting the story, the narrative for Intel?
Yeah, so AI has broadened the demand for compute more generally, not just for AI chips, but also for the more traditional computer chips, CPUs, which is what Intel makes for data center servers. So, not only is there this sort of rocketing demand for AI chips like the GPUs NVIDIA makes, but also there's starting to be this massive wave of demand for CPUs, including Intel's.
Also, just quick question. The preview you wrote up, you also highlighted memory shortages. Walk me through that, potential impact.
Yeah, so, one thing my colleague Dan Howley's written about a lot is that the cost of memory and storage are rising, and that's going to potentially impact the end demand for PCs. So the memory that's that's made by companies like Micron, and we've seen Micron shares rising a lot recently too. Because memory is increasing, that memory that is used alongside Intel, and that will basically boost prices for the Intel in products that use Intel chips. And so that could potentially dampen, consumer demand for PCs, which would then impact Intel's bottom line.
Hit those end products. Laura,
Right.
Thank you. Appreciate it. We'll see.
Thanks.
Coming up, Elon Musk making his Davos debut this morning. We're going to be diving into the biggest takeaways from the event. That's coming up next. Tesla announcing its robotaxis have hit the streets of Austin with no safety monitor. Here with more on the autonomous space. Let's get to Yahoo Finance's Praz Subramanian. Praz.
Yeah, so the big catalyst is here, I guess. So Musk announced today after some videos were posted on X.com. Musk linked to one of them and said, "Yes, we are doing." He wrote, "Yes, we're starting." Excuse me. Started Tesla robotaxi drives in Austin with no safety monitor in the car. Congrats to the Tesla AI team. Now, the Tesla AI team, led by Ashok Eluswamy, added that there's a few unsupervised vehicles mixed in with the broader robotaxi fleet with safety monitors, and the ratio will increase over time. So they're starting off slow. I think there's something like 20 to 50 robotaxis in Austin, and only a couple now have no safety monitors. So eventually they'll ramp that up, and that's sort of, it's unclear whether the state of Texas is giving them the approval to do that, or it's an internal thing. We'll see, but soon we'll have pretty much all of them unsupervised if things go well. And then California's a bit trickier there with the different licensing. But I think there's, there might be teller operators that Waymo uses too. So it's not fully, there's someone still watching. So don't feel like you're totally in the wild here. So, Waymo, we talked about it, is on top here, but, Tesla could catch up. The question is, who can scale faster?
You mentioned Waymo. Some news there too, expanding its service. Walk me through that one.
Yeah, so today this morning they announced they begin Miami service now. So a big part of the Miami greater area, and they're going to eventually add the airport, Miami International, as a destination for the Waymo robotaxis. And look, they're already in Austin, Atlanta, LA, Phoenix, greater San Francisco. They're going to add potentially this year Dallas, Denver, Detroit, Houston, Las Vegas, Orlando, San Antonio, San Diego, Washington, Nashville. So look, they've already proven they can operate in certain of these geographical regions. Level 4, meaning fully autonomous, but in a set region. The question is, like I said, whose tech is better? Can Tesla catch up? Probably. But the question is it safer? The metrics so far show that Waymo is a little bit safer, right? But that can change. And I think that Wall Street seems to believe, that Tesla can scale faster.
All right. Thank you, Pras. Appreciate it. Well, Tesla CEO Elon Musk took the stage at Davos for the first time ever after years of publicly ridiculing that event and arguing with the organizers. Musk using his time on stage with BlackRock CEO Larry Fink to tout the future of robotics and self-driving vehicles.
My prediction is that there'll be more robots than people. Probably sometime next year, I'd say that by the end of next year, I think would be selling humanoid robots to the public. I think self-driving cars is essentially a solved problem at this point.
Right.
And Tesla's rolled out a sort of robotaxi service in a few cities, and
right.
will be very, very widespread by the end of this year.
Joining me now is Ross Gerber, Kawasaki Wealth and Investment Management CEO. Ross, always good to see you. So let's talk Musk. Let's talk robotaxis. Different headlines, Ross. My colleague Pras was just talking about this, that the company started robotaxi rides with no safety monitor present in the cars in Austin. And then you heard Musk there at Davos, Ross, who was saying Tesla robotaxis will be widespread in the U.S. by the end of this year. What do you make of it, Ross?
Every goal from Elon is by the end of the year. Every year he has a bunch of goals that are by the end of the year that never happen. So I don't think that really matters. I think the proof is in the pudding, which is you can go outside right here in Santa Monica right now and take Waymos left and right. They're everywhere. They're very successful. Robotaxi is solved, and it's solved by Waymo, and they're scaling rapidly. This idea that Tesla is going to be able to rapidly scale robotaxi on hardware for cars, I think has not been proven. And until it is proven, it's a level 2 system. Now, I just got the new software uploaded onto my car. It's 14.223 now, so I haven't tried it yet, but I'm still having issues with the software, and I still think it's not done, and I don't think it's solved at Tesla.
Let me ask you, Ross, kind of broad. Listen, you're an investor, longtime tech investor, so I'm just curious, more broadly, just beyond just Tesla, when you think about the economics of a robotaxi market, Ross, like not near term, not medium term, let's think long term. What does that look like to you? What do you think growth and margins for such an industry could look like?
I spent a ton of time thinking about this because of Tesla and because of Google, which is now my largest investment in my fund GK, and also for my firm, that's not true, NVIDIA is still larger, but in my fund, Google is our top pick right now, and because they've solved so many of these issues. So longer term, what does this look like? Well, it looks like an ad platform to me, because it only costs about $1 a mile or less to buy a Tesla and just drive it around. So until the cost is below $1 a mile, which right now it's about 3 times that cost to use a robotaxi, it's still expensive to ride share relative to owning your own car. So first, that has to be solved. Once that's that's solved and the cost comes down, then you get into this race to the bottom because you have no barriers to entry. You have lots of competitors that have NVIDIA-based systems that will all be equipped in the next 5 years. And so the real question is, how can you generate revenue with a robotaxi when you're not making much money on fares? And so that's advertising, and that's where Google is also in the lead. You'll probably be watching YouTube in the car. There'll be ads on the car or in the car, but in the future, there'll have to be other revenue sources driving the profit margins of robotaxis. So I see this as a highly competitive, difficult business, and one, that I think is already kind of being mastered by, you have the old player in Uber and you have the new player in Waymo.
So we talked robo-taxis. I want your thoughts on robots as well, Ross, because Musk was making news there too, talking about how robots could eventually outnumber humans. Let's talk about that robot revolution, Ross. I mean, do you think, okay, yes, long term, that is technology that could upend, redefine verticals, households, factories, everything in between?
No, I think there's a limit to where robots will be, and I think that limit does run into the household versus working in factories where robotics is already being rapidly deployed, not only from Amazon but so many other companies. So robotics, there might be tons of robots in the future, but they're not going to look like humans. They're going to look like the issues they're trying to solve. Like my kid's tennis robot that hits him balls does not look like a human swinging a racket, and so it's a very good, effective training tool. My kid just bought this robot thing for tennis, and it's great, but it doesn't look like a human. And humans have lots of limitations, as I've learned playing tennis, by hurting my foot. And so your feet are very, very difficult to make. And so this idea that we're going to have robots walking around like humans and handling things with our hands and having the brains and even the memory chips to even have brains, anything like a human, to perform stupid tasks like folding, it just doesn't make a lot of sense. That vision I don't see. So I see robotics being a major, major theme for investors moving forward from an industrial perspective, but not from a consumer.
Another headline I want to run by you, Ross. The headlines were dropping fast and furious today. Your timing is impeccable as always. Report saying SpaceX, Ross, you saw this, lining up bankers for a potential IPO. In terms of timing, they're saying could be this year, valuing SpaceX at around $800 billion. What do you make of that news?
Well, we've been hearing a lot of this already, and I think it's great news if you work at SpaceX, and we work with lots of people at SpaceX, so we couldn't be more excited at our firm for our clients and hopefully our future SpaceX clients, because if you work at SpaceX, we're here to help, and we have lots of clients there because it's a local company here. So we're very excited for SpaceX and what they've accomplished, and the valuation doesn't make sense, but that's not my problem per se, and nor would I personally be buying the IPO at $800 billion, but I think there's value in SpaceX, and it's a wonderful company. It's just what that value will be determined by the market eventually when it goes public. But I think most of the private companies today are vastly overvalued.
With Musk, though, Ross, is there key man risk at SpaceX in the way we talk about with Tesla?
I think it's different because SpaceX are really run by Gwen Shotwell. So the people at SpaceX are supremely, competent people with or without Elon. Elon, of course, is a huge asset to the company. But I think the reality is SpaceX performs pretty well without him. Unlike Tesla, which certainly has fallen behind in the last year because of Elon's not working at Tesla and working in the government. And he seems to be really focused at XAI right now, which is, doing a lot. So Tesla's kind of like the third thing on the list right now, still, despite a $1 trillion pay package and everything else. But he's having a lot of success in certain areas of his business, and he has a lot of challenges in certain areas of his business. So it's typical Elon. He's got a lot of moving parts, and some of it's doing pretty well, and SpaceX would be on that side of the coin, and some of it's not, and that's where Tesla is.
Ross, always good to see you, my friend. Thank you.
Yeah, thanks for having me.
Coming up, we bring you some of the top trending tickers on Yahoo Finance. That's next on Market Domination. Now time for some of today's trending tickers. We're going to start here with Meta. That stock climbing the most in almost 6 months. The broader market rally lifting tech stocks, and Jefferies reiterating Meta as a top pick. The firm saying to buy the dip in Meta as it also sees an attractive risk-reward potential. Analyst Brent Till sees the company solidifying an AI strategy to boost its core ad business, given recent hires and the potential release of a new model in the first half of the year. Jefferies maintaining its buy rating on that stock and a price target of $9.10. Meanwhile, Alibaba reportedly preparing to bring its chip-making arm, T-Head, into the public market. According to Bloomberg, Alibaba plans to restructure that unit as a business partly owned by employees. Then the company will explore an IPO, though the timing for that remains unclear. And lastly, McCormick reporting earnings miss for the fourth quarter. Full-year guidance for earnings also falling short of the street's estimates. The company noting global trade dynamics continue to create headwinds and facing higher costs for the year. The company adding that it is leveraging competitive advantages, productivity initiatives, and cost management discipline to help mitigate these pressures. Well, shares of crypto firm BitGo jumping after making its public debut on the New York Stock Exchange today. The first big IPO of 2026 could be setting the stage for a few other big names like SpaceX and OpenAI to list later this year. BitGo's IPO comes at an interesting time for the crypto market. Bitcoin down over 14% in the last 12 months. Highly anticipated crypto legislation has been put on the back burner. Plus, last year's crypto-related IPOs like Bullish, Gemini, and Circle haven't performed very well since their listings. BitGo's co-founder and CEO Mike Belshi joined Market Catalyst this morning to discuss the decision to list now, competition in the space, expected legislation, and a whole lot more.
I think everybody that's in digital asset space is here for the long term. So kind of the ups and downs of where the market is a little bit less relevant to us. We actually started this process, last fall. We thought we were going to kind of get out onto the markets around October, but the government decided to take a little holiday, and so we ended up delayed out until January. But look, I think it's a good time. We've got a lot of business to be done. The fact that we're a public company now is bringing so many more potential clients to us. I mean, really, I think the last year with the regulatory changes, our total addressable market doubled, and then I think with this change, actually our TAM just doubled again.
So the TAM may be higher, but there's also a lot of people in this game, if you will. You guys offer custody, among other services. Coinbase offers custody, Fidelity Digital Assets offers custody, Gemini offers custody. There are a lot of players out there. So what is your pitch to investors about what your competitive moat is in that area?
Well, look, if there's one thing I can dispel right here, it's like, look, we're not a custodian. It's not like we had some grand plan to become just a custodian and that was the end game. No. It's a means to an end. We build infrastructure is what we do, and we build it at the highest compliance and security levels that anyone can ask for. So we're a brand you haven't heard of as much. We're kind of a brand behind the brand, so to speak, and that's because we focused on institutional demands. Now, by the way, we believe everybody on the planet, whether you're retail, whether you're institutional, deserves to have the same level of protection. You deserve to have a fiduciary that's overseeing your money, and we make sure that happens. You get it with your bank, you get it with your stockbroker, if you've got an RIA protecting your investments, all of those guys are fiduciaries. You come to us, you open up your account, you get a fiduciary account. Institutions out there demand this, and so we've always been providing it. We're just continuing to expand that. How we make our money is actually on the services on top, and that includes trading, that includes staking, borrow and lending services, collateral management, and then we also offer this thing called the Go Network, which is a settlement network, which operates not just here in the United States, but across our 7 custodians that we have globally. So we've got a really large footprint, not just here, but also abroad. We connect that all together so that people can do digital assets everywhere.
And Mike, how closely is your revenue tied to the amount of assets on the platform? So in other words, if the price of crypto goes down and the value of the assets goes down, does that mean you're making less?
Yeah, look, I mean, some of our products are certainly correlated to the price of Bitcoin and digital assets. I mean, there's no denying that. But look, it's our job to build a business that hopefully is more resilient than just based on that price. So look, I'd like to have the numbers speak for themselves. Go check what we did in Q3, check Q4. It's all in the S1. You can analyze it yourself. I think in general, coming into the market right now, most people looked at Q4 last year. They said, hey, it was kind of a rough time for the tech sector, even a tougher time for the crypto sector. But I think if you look at BitGo's performance, I think it speaks for itself and it was outperforming.
Well, if you look at the numbers for you guys, the 12 months ended September 2025. I think you guys had 164.7 or so million dollars in net income, but that was lumpy, if you will, right? You saw a drop in the first half of 2025. And I know you guys have been investing to build. You're going to invest in the proceeds from this IPO to build. How exactly are you investing them? And then when do you expect to get to a more sort of sustainable profitability path?
Well, look, I think it's sustainable now, but look, we're a growth company. So look around what's going on with digital assets. Like what we just saw last year, the number of regulated firms that can now touch digital assets that couldn't before. Look at the announcements that are coming out in the market every day, whether it's the New York Stock Exchange's announcement this week, whether you're talking about companies moving to 24/7. All of these guys need digital. And as they move into the digital realm, they've got two options, right? Either they build it completely from scratch, and these are digital assets, right? So they are very different than anything we've ever seen before. Folks need help. So oftentimes they come and they turn around and they partner with us. So look, I know you can get sensitive about the price of Bitcoin being like the total barometer for how our company or our industry works, but as the base grows broader, that changes. Look, we are going to run this company responsibly. One last thing, I mean, BitGo's been around for 12 years, 13 years, and we've raised the least money of kind of anybody in the space. We raised about $200 million total, and we're profitable to this day. So we think the business works. I think also what you see in Q4 is that the EBITDA can start to creep up. So it is a business that will scale. But for right now, we're investing in growth locally and abroad and across multiple product lines.
Mike, something I'm really curious about, you control the majority of the voting power of the shares here, more than half, 55.5%. You own less than 8% of the economic interest. And that's not necessarily, on the face of it, unusual. We see those kinds of patterns in Silicon Valley. It's just more extreme than we usually see in terms of the gap. So you're effectively saying to potential shareholders here, trust me. Why should they trust you? What are you telling them?
Well, look at my history, but look at my pedigree. I think actually it's going to give a more consistent stewardship for the company. Obviously, the board of directors agrees as well. It's not just my decision that went into that. A little bit about me, I'm not actually from Wall Street, even though here I'm at the New York Stock Exchange today. I come from 30 years background in technology. Started my career at Hewlett Packard, was at Netscape before that was a household name, did a number of startups. We are here to build and innovate. We build infrastructure, we're a brand behind the brands. We have to work with the utmost of brands. The fact that they're working with us today means that they've done their diligence, and hopefully that signals the right thing. Obviously my job, still deliver great value to shareholders.
Coming up, I talked to Huntington Bank's CFO about the company's latest earnings results. That's next on Market Domination. It's been a busy day for earnings, and we also heard from Huntington Bank. Those shares under pressure as fourth quarter results missed expectations. Joining me now, we got Zachary Wasserman, Huntington Bank CFO. Zach, it is good to see you as always. So let's dig into these results, Zach. You report the stock did drop in today's trade. It looks like Q4 EPS, Zach, misses consensus. It looks like expenses missed as well. Let's just start there. What's going on there? Walk me through what you're seeing in the business.
Sure. And what we're seeing in the business is extraordinarily strong results, to be frank. Revenue growth in the fourth quarter was 11%. Profit growth for all of 2026 was 2025, I should say. It was 16%, and it was 11% in Q4. So we're seeing really strong performance. I think, honestly, what we're seeing right now in terms of the stock and what the discussion was with analysts was really expectations for 2026 and reactions to some of the guidance we were giving. We gave guidance that we'd see continued strong growth in the business. We're seeing organic growth across virtually every area and revenue growth growing between 11 and 14%. But we also expect expenses to grow, not surprisingly, and in this case between 10 and 11%, which was a little bit higher than the investment community had been expecting. And so perhaps some adjustment there. I think what we tried to articulate during our call was that the model that we have is a flywheel for value creation. We're investing back in our business. We're building differentiated capabilities. That's helping us win market share, drive revenue, and ultimately drive incremental profit growth in a sustainable way. So we think the model is right. Of course, at times you need to recalibrate expectations, but we have every confidence the business is going to continue to perform very well in 26.
On the expenses, though, Zach, can I just circle back on that? Are they higher than maybe consensus? How much of that was due, Zach, to maybe, one-time integration costs with the Veritex deal?
To some degree, we are, of course, bearing some integration costs now, but those are coming in as we had expected. I think primarily what investors perhaps hadn't expected was on 11 to 14% revenue growth, that you might see expense growth as much as 10%. That's seemingly a high number, but the reality is that we're a fast-growing bank, and what we're focused on ultimately is operating leverage. By that I mean growing expenses less than revenue, continually expanding our operating margins. We expanded operating margins in 2025 by almost 3%. And the objective and the guidance that we gave for this year was between 1.5% and 2%. So those are really good results. And again, a sustainable balance of delivering profitability, but also reinvesting back in the business.
How does the consumer and small business look to you, Zach? And how much has it changed versus if I asked you that question 6 months ago or 12 months ago?
What we're seeing in the business environment now is continuing to indicate pretty solid growth. In fact, we're quite bullish about 2026. On the consumer side, we're seeing behaviors that are very normal. Spending activity actually accelerating from earlier in 2025. All of our deposit and account acquisition activities are very consistent. We're growing well there. Credit quality is very stable, really no change. And so to some degree, I think we're growing a little faster today in terms of the consumer space than we might have seen underlying economic growth in the first and second quarter of 2025. So that's obviously positive. On the commercial side, likewise, businesses are expanding. I think there's a general sentiment that 2026 will be a solid year for commercial growth. And so that's translating into lending activities picking up, fee-based service usage in terms of payments, and wealth management and capital markets is also performing quite well.
Zach, as a regional bank, you also, of course, have line of sight into our housing market. What are the trends you see there?
Well, I think, given that longer-term interest rates have come down and therefore mortgage rates have come down, we are starting to see more activity from a home buying and home mortgage refinance perspective. We're seeing between 10 and 20% year-on-year growth in mortgage origination activities now versus where we were this time last year, which is clearly healthy and indicative of kind of a restoration of that market in a positive way.
President Trump, Zach, has been making headlines, right? Economic policies, regulatory policies, including ideas about housing. When you think about all those policies, Zach, which could be the most, potentially impactful on your bank, on loan growth or margins? I mean, just as a CFO, you're watching all these headlines. What's on your radar there?
Yeah, well, we certainly applaud the president's focus on affordability. That's very important for the U.S. economy, and there are segments of the consumer population that have been under pressure for a while from inflation and interest rates, and so that's a really notable focus, and we applaud it. The thing that I think is helpful is long-term interest rates coming down, and so there's a lot of focus on how can the Fed and other agencies support that through their interest rate policy and through the nature of the balance sheet there that could potentially be supportive for mortgage-backed securities and spreads and for that market to function well. So those are the kind of things that could be impactful. Ultimately, as you know, and we've discussed over time, we focus on what we can control here at Huntington, and that's really serving the customer and making sure that we're where they want to be, and we're seeing a lot of success as it relates to that.
Zach, always great to see you and to have you on the show. Thanks for your time.
Pleasure to be here.
Well, TikTok's U.S. business is finally set to have a new home as the U.S. and China signed off on a deal. Its new owners will be a group of investors, including Oracle, which is up today. That's according to Semaphore, reporting that the deal is set to close this week after a years-long saga over its assets. The fate of its algorithm remains unclear. Dan Halley joins us now. Dan, what do you know?
Yeah, that's right, Josh. This is, again, being reported by Semaphore. It's basically just the final move with this kind of agreement between TikTok, ByteDance, the US, China, and these various entities that are going to now take control of it. So this has been ongoing. Obviously, Trump in his first administration said, TikTok, bad, gotta ban it. Biden came in, said, yeah, let's ban it, signed it into law. Trump did well in the election on TikTok, said, hey, maybe it's not so bad. And then all those national security concerns that were talked about for the last 8 years kind of evaporated overnight. And so now the company is being forced to still sell. ByteDance has to sell a portion, their portion of TikTok. They will hold on to slightly less than 20%, while the rest goes to the likes of Oracle, Susquehanna, a United Arab Emirates investment firm, and a few others. And basically, what we're curious to see is how the algorithm works out here. That's kind of the real thing that everybody is interested in when it comes to TikTok. It's what keeps people scrolling over and over and over and over again. How is that going to evolve now under new leadership? And I think that's going to be the biggest question for the company, and it'll determine whether people stay on or not. I mean, look, social media can be very fickle. There's been times where people have said, high-profile figures have said, Instagram made a change, Twitter back then made a change, X, whatever made a change. We're going to dip, and then a bunch of people ended up following suit to other platforms. And so we could see something like that with TikTok. It is still highly addictive to most people, and so that stickiness may keep them on. But I mean, it really comes down to what they end up doing with the algorithm, and whether or not it's going to be changed up or not.
All right, here's another headline I want your Dan Howley take on. Apple headline. Bloomberg's Mark Gurman reporting, as we were talking off camera, it's always Gurman.
He lives in the walls.
He lives in the walls. I'm convinced Tim Cook's kitchen, he's bugged it. Something.
Little radio?
It could be anything. Great reporter.
Oh, yeah.
And mensch of a guy, I would just add. Okay, here's what Gurman says. He reports, get the Dan Howley analysis of this. Gurman says, Apple quietly gave hardware chief John Ternus oversight of the company's hardware and software design teams at the end of last year. Gurman saying, marking first evidence he's being promoted for the eventual Apple CEO role. What do you think?
It's interesting. Tim Cook he's not exactly, ancient by any stretch of the imagination, but he's getting up there as far as just general workforce age, right? I mean, also, if I was him, I would have retired like 10 years ago, take that money and just hang out, no big deal, right? But some people are different. And Ternus has been kind of the name that's been bandied about for quite some time, and so it would make sense that he's getting an expanded role here. Gerber obviously points out that Craig Federighi's still going to have a say in things. The hair, great hair,
amazing.
Always at WWDC, but it is the kind of expansion of roles. Just I think seems to cement this idea that we will see a changing of the guard at some point. Obviously in the future, but perhaps in the coming few years. And it seems as though it's a way of kind of ensuring that everybody is aware that this is coming. So it's not going to be like the rug is pulled out from underneath you one day. You're looking at Apple and you're thinking, that's not Tim Cook anymore. Who's that guy?
Was Ternus, would he have been your strong bet?
I think so. Yeah. Just based on age, based on what he's done, how long he's been at Apple. He's a charming public speaker. I think all of those things are very important to a role like that.
Yeah.
And Tim Cook's had it in the bag for quite some time. He's got the very soothing kind of Southern drawl almost. Yes. He's able to speak to folks from around the world. He plays the political game very well, obviously, especially in DC as well as abroad and in Silicon Valley. And so,
fierce diplomatic skills.
Yeah. And one of the interesting things here is we were talking about is, he was the operations guy, right? Like he was the logistics guy for the company.
Supply chain guru.
Exactly.
Totally,
so it seems as though they may be going in a different direction, kind of pivoting that towards the design kind of aspect of the job. And so we'll just have to see what that means. I mean, Cook has managed to move, from China, get everything into China to saying, okay, well, maybe we have to diversify more into other countries, dealing with the threat of tariffs, setting up in India so that they can actually sell there, and other nations around the world committing to building some products or servers in the U.S. So obviously he's been able to do things along those lines. It's one of the largest companies on the planet, huge job. We'll just have to see if and when Ternus does take over, how he picks up that kind of position.
All right, Dan. Thank you, sir. Appreciate it. We're wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.